Hi, this is Ben Reynolds with Sure Dividend, and today we're going to go over how to generate rising passive income through dividend growth investing. And just to let everyone know, you can use the chat function in this webinar to communicate with us. And Nick McCollum, one of our lead researchers and writers, is on as well, and he'll be answering questions in chat. And so with that said, I wanted to ask, where are you guys viewing from today? Please use the chat to answer. All right, and here's what we'll be going over today. We're going to break this webinar down into 4 sections. Section 1 is on why dividend growth investing. Section 2, how to use dividend growth investing to generate rising passive income, which is really the benefit of dividend growth investing. And Section 3 is on the 8 Rules of Dividend Investing, which is our quantitative strategy to build a dividend growth portfolio. And finally, Section 4 is an exclusive opportunity for webinar participants that I'm excited to tell you about. And it looks like we have people here from a lot of different places: Fredericton, New Brunswick, Philadelphia, San Diego, North Carolina, New Jersey. So we have people from Canada and a lot of the different states in the US. All right. And with that said, let's dive right in. Section 1, why dividend growth investing? Dividend growth investing is about building rising passive income by investing in companies likely to continue increasing their dividends in the future. Its unique focus on both current income and income growth makes dividend growth investing suitable for both retirement and early retirement. And when you think about the needs of retirement or early retirement, it's not just about current income. It's about income now, and hopefully income that's growing at least at the pace of inflation, if not faster. If your income is constant and not growing, the effects of inflation will erode it, where your purchasing power doesn't keep up. And in this presentation, we're going to answer the following questions. Why buy individual stocks instead of mutual funds, index funds, or other passive investment products? And that's the majority of investors invest primarily in funds, and there's a lot of misconceptions about investing in individual stocks that we're going to tackle today. And secondly, we're going to go over why choose dividend growth investing over other investing strategies. There's a lot of benefits to dividend growth investing that we're going to go over. All right, why buy individual stocks? Reason 1, mutual funds and other passive investing products force you to buy overvalued stocks. The following image, which you can see in the table below, shows the largest holdings in the S&P 500 index right now. And you can see that the price earnings ratios on these are very elevated, especially with Amazon, Google, Facebook. These are very high price earnings ratios. And to put these in context, the historical average price earnings ratio for the S&P 500 is between 15 and 16. Right now, the S&P 500's price earnings ratio is well in the 20s. So it's historically overvalued, and that's reflected in the individual stocks in the index. So when you're buying into an index like the S&P 500, you're buying into a lot of companies, some of which might be undervalued and good buys, some might be overvalued. And value is a function of both growth and earnings today. But you can look at these names and see that in general, the price earnings ratios are elevated. So buying an index today means investing in stocks you probably wouldn't own otherwise. The second reason to buy individual stocks over funds is that most index funds or mutual funds charge excessive fees. And the fees that investors look at most often are just the expense ratio, but the actual costs of fund ownership are well in advance of just the expense ratio. And the table below is from Forbes, and it estimates the real cost of owning a mutual fund. And you can see it's 3.2 percentage points in a tax-sheltered account and 4.2 percentage points in a taxable account, which is a tremendous drag on return when you think that the market's average return over the long run is 9 to 10%. So you're giving up 30 to 40% of your returns to invest in a fund. And the breakdown below, you can see the expense ratio, which, as I said, is the most commonly looked at cost of owning a fund. But the fund incurs transaction costs as well. The fund itself is buying and selling, and that will damage your returns. And transaction costs include both the cost to buy and sell, but also the spread on the bid and the ask for when these funds are making purchases. And some rebalance quite often and have very high turnover, which is why you'll see high transaction costs. And when you're investing yourself, you can minimize transaction costs by trading infrequently. And we'll talk more about that later, because there are significant advantages to making fewer trades. And then you'll see the cash drag, and cash drag isn't talked about often, but that's in a fund, they might need to hold 10% of the value of the fund in cash to make purchases and to have a buffer there for buying and selling and fund redemptions, that type of thing. So this all adds up to pretty substantial total costs for funds that you probably wouldn't think about if they weren't presented. And the image here shows the growth of $1,000 invested in a mutual fund with different fee structures. And you can see over time, the fees really add up. The 4% a year cost, that account ends up being worth less than half of the account that had no fees at all. So this really is a tremendous drag on returns. And when Wall Street or when fund managers are trying to sell you a fund, they're going to not focus on the cost of the fund. But investing is difficult, and it can be difficult. And one of the big ways that individuals can do better in the market is to reduce what they're paying to invest as much as possible. And today more than ever, it's easier to reduce the fees you pay. Why buy individual stocks? Reason 3. It is possible, in fact, it can be easy to create an appropriately diversified investment portfolio by buying individual stocks. And that's one of the big alleged benefits of funds is, oh, hey, you can buy 500 stocks with one fund. You're super diversified with owning just one fund. And that's true. You are very well diversified. I would argue extremely over diversified if you own 500 stocks. The reality is that most of the benefits of diversification are achieved through owning as little as 20 stocks. And we believe the sweet spot for stock ownership is between 20 to 30 stocks. And we'll go into more detail on diversification and the optimal number of stocks to hold in your portfolio later. But it's an interesting topic and one that there's a lot of misconceptions about. And when you buy individual stocks, you can invest in your best ideas, the stocks you're most confident holding. You don't have to invest in your 400th best idea like you would if you're buying a large fund. You can concentrate your portfolio on your highest conviction ideas. And that makes intuitive sense. And most of the great investors of today and of the last century concentrate their portfolios in their best ideas. And there are a few exceptions, but in general, that is the trend. That covers just why stocks versus funds in general. Now we're going to go over why dividend growth investing as a strategy. The primary reason, and you'll hear this throughout the presentation, is that dividend growth investing is conducive to long holding periods. When you invest in dividend growth stocks, you're looking for companies that are likely to raise their dividends over time. So you're looking for businesses with strong competitive advantages that you can buy, hold, and sleep well at night. So you're not worried like, oh my goodness, is their patent going to expire tomorrow? Are they going to generate revenue? Is this a pre-revenue biotech company? You don't have to worry about that when you're investing in strong, stable, boring businesses, as some people would say. And the quote below is from Seth Klarman, who's one of the greatest investors of our time. He's the manager of the hedge fund Boppost Group, which is a value-based hedge fund with phenomenal long-term returns. It's averaged close to 20% a year over, I believe, over 20 years or around that time period. So phenomenal investor. He says the single greatest edge an investor can have is a long-term orientation. And that's really powerful. This is the single most important thing you can do with your investing is to have a long-term orientation, thinking for the long run, investing for 5 or 10 years down the line instead of for next month or tomorrow. It really focuses you onto what your advantages are as an individual. And I'd like to go over those advantages briefly now. There's an institutional imperative. For a fund manager, they need to show solid performance every quarter. If they lag the market for a quarter, people might start trading in the fund for a different fund. So it's important that they constantly show good performance. And this leads to short-term thinking. What stock will do well next quarter? And you're not even looking at a year out in many cases. You're looking at quarters, 3 months at a time. And this is counter to how you would invest normally. If you're investing in a standalone business, no one would say, oh, I'm going to start a business so it'll be worth a lot in 3 months. That doesn't make sense. You'd start a business for the long run. You'd invest in a business for 5-10 years because you can't control what happens in 3 months. And then as you look, there's high frequency hedge funds that have massive advantages over an individual in the cost of trading. So you're competing against incredible algorithms that put you at an extreme disadvantage if you're trying to day trade or trade in short periods of time. If you're trading in the 3 month type range, you're competing against some of the smartest people from the Ivy League colleges that are working on Wall Street and working in giant investment firms. Difficult to beat those people as one person. But when you're investing for 5 or 10 years out in the future, you're not competing against these people. You're playing an entirely different game, and it's a game that suits your situation because for almost anyone, even in retirement, you're looking at the long run. You want your wealth and your portfolio to be there throughout, not just for the next 3 months. Long-term investing enables investors to spend less time watching their portfolio. Again, if you're thinking long-term, if a company you invest in has a lackluster quarter, it's really okay as long as the competitive advantages remains and the company has solid long-term prospects. Long-term investing also allows you to legally defer capital gains taxes. This is a phenomenal advantage. You don't owe capital gains taxes unless you sell your holdings. And you can see Warren Buffett do this. He will hold stocks for decades, and he might have better investment opportunities elsewhere, but instead of selling and having to pay a tremendous amount in capital gains tax, he keeps that money invested in one company or in the company that it's in and allows the money he would have to pay in taxes to continue growing in that company. So you defer those capital gains taxes and allow them to compound. And long-term investing is also excellent at taking advantage of compound interest because you're investing in great businesses that they grow over time, that compounds. So you really have a tremendous wealth generating effect. Why dividend growth investing? Reason 2, dividend growth investing is simple. The quote below from Warren Buffett really lays out his whole strategy very succinctly, which is very nice. He says, we select investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. And here this just means a business that's not publicly traded. So investing in a normal business that's not on the stock market. 1, favorable long-term economic characteristics. And there's that long-term thinking again. And notice that's the first thing he's looking for. Number 2, competent and honest management. You wouldn't want to invest in a company that the management's shady, doesn't have the shareholders' best interest in mind. That can damage returns over time. It leads to situations like Enron. You need to be involved with people that you can trust in business and just life in general. Point 3, purchase price attractive when measured against the yardstick of value to a private owner. And again, this just means don't buy a super overvalued business. Buy into a strong business that's trading at a reasonable price that you would buy if it weren't on the stock market. If it were a private business, would you buy it at this price? And for an industry with which we are familiar and whose long-term business characteristics we feel competent to judge. And this is another interesting point. Warren Buffett is famous for talking about his circle of competence. Don't invest in things you don't understand. If there's this amazing new blockchain technology, you're not familiar with how it works, but you see, oh, everyone's getting very rich investing in cryptocurrencies. If you don't understand how it works, you can't judge if that's a good investment or not. So you shouldn't put your money into things that you can't judge if it's a good idea. And this applies to stock investing in that you don't need to invest in a startup tech company that is promising some revolutionary virtual reality technology that they have patents on that's pre-revenue, but they sound really, really smart. But you can't judge that. You have no idea. I would have no idea what they're talking about. And you compare that with a company like a Coca-Cola or a General Mills. These are companies that are selling food or beverages in the case of Coca-Cola, and primarily food products in the case of General Mills. It's a very easy business model to understand. And you're probably familiar with the products they sell. And those can make fabulous long-term investments just the same as a very complicated investment. The difference is when you understand it, you have a lot more confidence in it, and you're less likely to sell at the first hint of bad news. And if you add rising dividends to Warren Buffett's description, the 4 points above, it's basically dividend growth investing. The only difference is dividend growth investing prioritizes an income stream and a growing income stream in addition to the 4 points above. But they really go hand in hand. There are psychological benefits to dividend growth investing. As I was discussing just in the previous slide, when you know the business, you can have more confidence in it. All businesses go through fluctuations. They all have bad quarters occasionally. They have bad years sometimes. That's normal for every business. If you don't have confidence in the business and you're not familiar with it, it's a lot more difficult to hold when there's some problems in the business, temporary problems. It's important to make a distinction between a business is failing versus, they made $2 billion last quarter when they're supposed to make $2.2 billion. That's not that big of an issue if there's a plan to correct it, versus the business is not making any money and they can't cover their dividend. That's a completely different issue. But when you're aware of the business, when you're invested in, and these are all dividend growth stocks below, when you're invested in a Nike or a Starbucks or a Disney or a Walmart, these are companies you're probably familiar with. They're paying you more in dividend income every year. And it's a lot easier to hold those businesses than it would be for a more complex business or a less proven business. For me, when I hear, okay, Coca-Cola's paid its dividend, has increased its dividend every year for over 50 years. It's been around since the late 1800s. It's probably not going to go out of business tomorrow. I have less confidence in Groupon as an example, because they've been around for 5 years. So there's just an extra psychological benefit there. Section 2, how to make the most of dividend growth investing. In this section, we're going to discuss how to adequately diversify your investment portfolio, which is something we've touched on earlier, but we're going to go into it in more detail in the coming slides. How to properly reinvest dividends. And in the dividend community, creating dividend reinvesting is popular, and we're going to go over that in more detail in the coming slides. And then how to find high quality investment opportunities by creating a systematic investing strategy. At Sure Dividend, I'm very big into systematic investing to minimize behavioral errors and biases. The problem with all investors, myself included, is that there's emotion involved and we make irrational decisions. And when you have a systematic strategy or a plan ahead of time, you're much less likely to make those errors that are going to reduce your returns. First up, diversification. Diversification is often touted as the downside to investing in individual stocks. And I mean, if you own one stock, that's very dangerous. But there's no reason to just own one stock. The cost of buying a stock is extremely low today. Not being able to diversify an individual stock portfolio is a myth. And moreover, you don't have to own 500 stocks. Most of the benefits of diversification are achieved from owning as little as 20 stocks. And the image below shows how with each additional stock you add to your portfolio, there's a decline in how beneficial it is for your diversification gains. So the gains in diversification from one stock to two stocks is gigantic. The gain from 100 stocks to 101 stocks is virtually non-existent. And you can see that curve really flattens out around 20 to 30 stocks. If you're familiar with the 80-20 principle, you want to focus on the 20% of whatever it is, the 20% of activities that generate 80% of the value. If you apply that to your investing strategy, you will invest in a portfolio of 20 to 30 stocks, your 20 to 30 best ideas, the ones that are going to be responsible for the vast majority of your returns, or the ones that should be if you would focus on them. But on the flip side of this is you are getting almost all the benefits of a 500 or 5,000 stock portfolio with holding a portfolio of 20 to 30 stocks. And that's important to remember. Too much diversification is a bad thing. When you own 100 stocks, you're taking money from your best idea and putting it into your 100th best idea. I mean, for me, if I'm deciding what I want to do with my time, I don't say, okay, well, what's the 100th best thing I can do with my day-to-day? You focus on your best ideas. It's the same with investing. And of course, this should be said, with the 20 to 30 stocks I was discussing, you have to be reasonable. If you invest in 30 upstream oil and gas companies, you're not diversified. You have to be reasonably diversified within different industries and sectors. And the quote below from Warren Buffett says, diversification is protection against ignorance. It makes very little sense for those who know what they're doing. And this is absolutely true. The amount of diversification you need is related to your skill as an investor. So Warren Buffett holds an extremely concentrated portfolio. I think he has over 50% of his wealth is in 3 or 4 stocks in the Berkshire Hathaway portfolio. And you can get exact numbers elsewhere, but it's close to that. Whereas if you're not Warren Buffett, you probably don't want to put 20% into one stock. And again, with the 20 to 30 stock portfolio, if you equally weight that, you'll have 3% to 5% of your portfolio in any one stock. So you're not going all in on one company, because no one can tell what's going to happen in the future with certainty. So you don't want to go all in. But a moderate amount of diversification is important. More than what Buffett has, less than a giant index fund. And that's the sweet spot for us, again, is the 20 to 30 stock range. Next, we're going to talk about dividend reinvestment. Some companies offer a dividend reinvestment plan, but since this is investing in finance, everything has an acronym. Here's DRIP for short. So DRIPs are reinvesting dividends back into the same company that paid them. So if a company has a share price of $100 and they pay $3 a year in dividends, you'd automatically take those $3 that were paid and buy more shares. So you'd get an extra 3% a year of stock in that company. And over time, this can really compound and add up, because when you're talking about a business that is increasing its dividend every year, and you're increasing the amount of shares you own in it, you're really building a powerful passive income stream quickly. DRIPs only make sense if the company you're reinvesting the dividend into is currently your best investment opportunity. And when you think about it, say you bought a stock 5 years ago because you're a long-term investor. It was a great buy at the time. Today it's looking a little overvalued. Nowhere where you'd want to sell it, but maybe it's not where you want to keep adding money to it. You can take the dividends that company pays, and this is if you're in the accumulation phase, so you're not actively using the income from your portfolio. You can take the dividends that slightly overvalued company pays and invest them into your best idea today. So if today you think Cardinal Health is a phenomenal investment, you can take the dividends that you're getting from another company that you invested in 5 years ago and put them into Cardinal Health. So you're really optimizing the cash that you have. And that's what we recommend at Sure Dividend instead of DRIPs. But that said, I have nothing against using a DRIP. There's certainly worse ways to invest. So it's at some level, it's a style choice, but when you think about it, reinvesting back into your best idea seems to make more sense. Now we're going to discuss creating a systematic investing plan. The Sure Dividend uses the 8 rules of dividend investing, which we'll discuss a bit later. But we use factors that have historically either improved returns or reduced risk. So when you're building a systematic investing plan, you wouldn't want to just, I like stocks that their logo is blue. Well, that's not going to add anything to your screen or your ranking system or your plan. You want to build a plan that's likely to produce solid long-term results. Some examples of factors that have historically either increased returns or reduced risks are the low price earning ratio stocks. So these basically cheap stocks outperform expensive stocks. And this is because people fall in love with glamour stocks, the Amazons of the world, and say, hey, this company is going to grow at 20 or 30% a year forever. So we can pay a price earnings ratio of 300. It'll all work out because it'll grow forever. In reality, there are diminishing returns as a company gets larger. Companies cannot grow forever. They slow down as they get gigantic. So no company in the history of investing has kept up a 20% return for a very long period of time. If they did, they'd be worth more than the entire global economy. So that's an example of kind of shorter term thinking where it gets carried out in an illogical way into the long term. And you contrast this with low price earnings ratio stocks. These are companies that the expectations are low. So if they have any good news, their stock prices tend to rise. Another anomaly is low stock price volatility. And this just means that volatility is just basically the bounciness of the stock price. So stock prices that don't move around as much tend to perform. This is very interesting. They tend to perform better with low volatility stocks, perform better in a total return scenario versus high volatility stocks. So they actually have better returns with lower volatility. And the general academic sense was that risk is related to return. The greater the stock price volatility, greater returns. It's exactly the opposite. The lower the risk, the higher the return, or at least there's a correlation there. And when you look at low volatility stocks, they tend to be dividend growth stocks in many cases. Typically utilities, because their income streams are so secure, will have low stock price volatility. And also some of the strongest dividend growth companies like Johnson & Johnson, General Mills, Pepsi, they all have extremely low stock price volatilities. And then another example of a factor that has increased returns is high dividend yields. All other things being equal, you obviously prefer a high dividend yield to a low dividend yield, and the research bears that out. High dividend yield stocks have historically outperformed low dividend yield stocks. And we'll get a bit more into these studies as we go. Investors in the accumulation stage, this is when you're building your portfolio and you're saving every month, should contribute a fixed amount each month. And this is really sort of basic personal finance. You should be saving monthly if you're saving, or when you're paid. Don't put it off till the last thing on the list. Try to save, so you can create a systematic plan to invest the same amount every month. For retired investors, we recommend reviewing your portfolio briefly about every month. And our Sure Dividend and Sure Retirement newsletters do cover a lot of dividend growth stocks, so that can be part of that review. Makes it very quick. A systematic plan allows you to avoid the behavioral errors that reduce long-term total returns. Systematic investing and cognitive biases. Probably the biggest advantage of systematic investing is drastically reducing cognitive errors. Investors succumb to numerous biases that impair their ability to achieve good long-term investing outcomes. A couple examples are below. Confirmation bias. This is when you believe research that confirms your existing beliefs while ignoring research that goes against your point of view. So if you invest in a company and they start doing badly and then they cut their dividend and they're really struggling and looks like they're going to go out of business, you might be like, oh, that's not happening, and you don't want to admit what's happening. Confirmation bias happens to everyone. People in general do not like to hear information that disagrees with their currently held beliefs. And this applies beyond investing. This goes to really anything in life. You can see it in every sphere of life: political, religious, investing, and it's an interesting thing to look out for in yourself and virtually impossible to avoid. But with a systematic investing plan, you can avoid confirmation bias in your investing life. in that small subset of your life by following simple rules. Loss aversion, and this is not necessarily bad in all cases, but investors tend to dislike losing a dollar far more than they appreciate earning a dollar. And the downside of this is it can prevent you from generating the wealth and the returns that you should be. As an example, if you have far too high percentage of your portfolio in cash or short-term treasuries, and you're generating 1% or 2% a year returns, you could be doing much better. And it's that fear of temporarily seeing the value of your account decline that's holding you back from doubling your money in 10 years, as an example, which would be, I mean, the S&P 500 on average total returns doubles your wealth about every 7 years. So it's important to understand loss aversion and not limit yourself to less because you're afraid of losing. With that said, you shouldn't take the absurd risks either. So there's a kind of a healthy medium there. Trend chasing bias is the tendency to chase historical returns despite the logical knowledge that past performance is no guarantee of future results. So here there's a kind of a lot going on, but this really applies more to bubbles and investing in something just because it had good returns. So just because in the tech bubble, just because pets.com was way up over the last 3 months, it doesn't mean it's a good investment. It just means people are trend chasing, and that works great until it doesn't, and then everyone's ruined. So it's important to understand that and do your own thinking as opposed to following what everyone else is doing. Now we're going to discuss the 8 rules of dividend investing. This is our systematic investing program to eliminate behavioral biases and improve long-term results. Specifically, this is our way to build a high-quality dividend growth portfolio for rising dividend income over time. The 8 rules of dividend investing are broken down into 5 buy rules, 2 sell rules, and 1 portfolio management rule that take advantage of some of the factors that we've previously discussed and some new ones that we haven't yet. And we'll explain each rule in the following slides. Here's this quote again. The single greatest edge an investor can have is a long-term orientation. And it really bears repeating because it's so important. This is, if there's anything to take away from this presentation or Sure Dividend at all, it is that having a long-term orientation, and I'd add, and not panic selling, holding during drawdowns, is absolutely central to building long-term wealth and to long-term dividend growth investing. The common sense idea here is to invest in great businesses that have a proven record of stability, growth, and profitability. So we're looking for businesses that are proven, that we can invest in over the long run. The quantitative rule here is to rank stocks by their corporate histories and their dividend histories. The longer, the better. So all other things being equal, we prefer a stock with a 50-year history of rising dividends and that's been around for 100 years over a stock that's been around for 3 years. The empirical evidence behind this rule is the Dividend Aristocrats Index. Stocks with 25 plus years of consecutive dividend increases in the S&P 500. So there's just 51 right now. They've outperformed the S&P 500 by a remarkable 3.3 percentage points a year over the last decade. So that's not 3 percentage points total in 10 years. That's per year on average. It's phenomenal returns. And they've actually done that with lower volatility. So that's kind of the holy grail of investing, is higher returns with lower volatility. That's what the Dividend Aristocrats have done. It's because they're proven businesses, they're high quality businesses, and they reward shareholders with rising dividends. That's what we look for as dividend growth investors. The second rule is the bargain rule, and the quote below is, price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. I think that's a really good quote, and it ties how you live the rest of your life with how you should be investing. No one goes out to buy socks and says, oh, well, one pair of socks is $2 and the other is $30. I'll buy the $30 one, even though they're the same, because I like paying more. But when it comes to stocks, people will say, oh, look, the stock price here doubled, I should get in now. When you want to invest in things that are a good value, not because they're expensive. And the common sense idea here is to invest in businesses that pay you the most dividends so you can increase the cash flow generated from your investments. Very simple to understand. It really makes intuitive sense. The quantitative rule here is also simple. Rank stocks by their dividend yields. The higher, the better. So again, all things being equal, we prefer a stock with a 5% yield to one with a 1% yield, as everyone else should if all things are equal, which they never are, but that's why it's part of a greater ranking system. The empirical evidence behind this is the highest yielding quintile of stocks. And a quintile is just a 20%. So the top 20% high yield stocks outperformed the bottom 20% yielding stocks by 1.8 percentage points from the 85-year period below. So that's a very long time period. So it's not a recent effect. It's something that happens over long periods of time. Rule 3 of the 5 buy rules is the safety rule. Another excellent quote from Benjamin Graham, who's really the father of value investing. The secret of sound investment is 3 words: margin of safety. And here, margin of safety, what Benjamin Graham means is, if you think a business is worth $100 a share, you might be off a little bit. That's an imprecise. It's an art, not a science. Only pay $70 for it. Give yourself a large margin of safety in case you're a little off. And the common sense idea here is to buying overvalued stocks eliminates your margin of safety. Stocks that are repurchasing, we put a little twist on it here. It's not just undervalued stocks. Stocks that are repurchasing significant amounts of their shares are likely undervalued. And the thinking here is that when a management team decides to use the company's cash to repurchase shares, they're saying, hey, we like these shares right now. They look cheap. They look cheap enough that we want to buy them back ourselves. So that's why we view share repurchases as an indicator of value. But beyond that, share repurchases give a margin of safety for the dividend stream of a company. So if a company is repurchasing shares, that means 1, they have excess cash because they have cash to buy back their shares. 2, if the company were to have a temporary decline in earnings, the first thing that's going to go isn't the dividend, it's the share repurchases. So there's a buffer there that you wouldn't have in a company that's not repurchasing shares. It shows cash flow, it has a buffer against dividends, and it hints that management thinks the company's undervalued in many cases. So the quantitative rule here is that we rank stocks by their share repurchase yields, which is just the amount of shares they're repurchasing divided by the price. The higher the share repurchase yield, the better. The empirical evidence here is that the S&P 500 buyback index, which tracks stocks that are buying back their shares, has outperformed the S&P 500 by an excellent 3.6 percentage points a year over the last 10 years. So again, this is slightly in excess of the Dividend Aristocrats index. I believe the buyback index does have a bit higher volatility, but it shows that companies that are repurchasing their shares on average make good investments, and we want to pay attention to that and factor that into our system. Rule 4 is the growth rule. All you need for a lifetime of successful investing is a few big winners. And that's from Peter Lynch, who had returns close to 30% a year over, I think, a 9 or 11-year period when he was running the Magellan Fund. One of the greatest investors of the last, he was predominant in the 80s, I believe, but one of the greatest investors around. Common sense idea here is to invest in businesses that have histories of solid growth and high likelihoods of delivering strong growth moving forward. So you might have heard me earlier talk a little bit about how high growth stocks tend to have high price earnings ratios. If they don't, you want that growth. Growth is good. It just matters the price you pay for it. So here, we're looking for growth so long as we don't have to pay for it. Quantitative rule, rank stocks by earnings per share growth estimates. If earnings per share growth estimates are unavailable or unreasonable, which can happen for a variety of reasons, then revenue per share growth or dividend per share growth estimates can be used instead. So here we're just trying to find the best measure of actual growth. The empirical evidence is that stocks with growing dividends have outperformed stocks with unchanging dividends by 2.4 percentage points a year over a 41-year period. So that's another very long study. The final buy rule is the peace of mind rule, and the quote is from value investor David Dreman. Psychology is probably the most important factor in the market and one that is least understood. And this goes back to volatility. Common sense idea is to look for businesses that people invest in during recessions and times of panic. These businesses will have a relatively stable stock price that will make them easier to hold for the long run. So it's easier to hold a stock that it doesn't go down as much when it goes down because there's just less stress. When you say, oh, look, my portfolio's, this is the Dividend Aristocrats index as a whole declined 22% in 2008 versus 37% for the S&P 500. So it's easier to hold when you're down 22% versus 37%. And that's kind of the psychological advantage of investing in lower volatility stocks. So our final buy rule, our final ranking procedure for the buy rules is to rank stocks by their long-term volatility. The lower the volatility, the better. And the empirical evidence here is that the S&P 500 low volatility index has outperformed the S&P 500 by 1.9 percentage points a year over the last decade. All right, those are the 5 buy rules, and those we weight all those and we put them together to come up with a concise list of the top dividend growth stocks. We have 2 sell rules and 1 portfolio management rule, and next we're going to go over rules 6 and 7, which are our sell rules. Rule 6, the overpriced rule. Warren Buffett says that for the investor, a too high purchase price for a stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. And you actually see this with Warren Buffett in Coca-Cola. The company was trading at a price earnings ratio over 40, I believe, around 2000, 2001, somewhere in that range. Buffett has said that one of his biggest mistakes was not selling Coca-Cola then because it was so overvalued that it needed a decade of growth to catch up to its inflated valuation. It's not that the business was bad, the stock price was bad. And the common sense idea here is if someone comes up to you and you have a home that it's generally worth around $250,000 and they knock on your door and say, hey, I want to buy your house for $500,000, you should take the money. It's the same within the stock market. If you hold a business that is wildly overvalued, you can sell it for much more than it's worth, and you can take that money and reinvest it into businesses that are better investments today. The quantitative rule here is to sell a stock when its adjusted price earnings ratio exceeds 40. This means you'll very rarely sell, and that's by design because we want to really focus on long-term investing and not rapidly selling. But if something's absurdly overvalued, it's better to sell it at that point. And the empirical evidence here, and this is the probably the wildest one there is with the amount of returns. The lowest 10% of price earnings ratio stocks outperformed the highest 10% of price earnings ratio stocks by 9 percentage points a year, which is a huge gap from 1975 through 2010, so a 35-year period. That's the value effect, and it's very important to pay attention to. Aside from long-term investing, the second most important thing is probably paying attention to value. Rule 7, the survival of the fittest rule, is another excellent quote from John Maynard Keynes. When the facts change, I change my mind. What do you do, sir? And this just the common sense idea here is if you own a stock that reduces its dividend, it's paying you less over time instead of more. And if you bought the stock to pay you more in dividend income over time, it's doing the opposite of what you wanted it to do and what it should be doing. So you need to recognize this and reinvest the money elsewhere. And the quantitative rule is to sell a stock when its dividend is reduced or eliminated. The empirical evidence here is that stocks that have reduced or eliminated their dividends had a 0% annualized return. 0% is not good from 1972 through 2013. So that's a 41-year period. And the final rule in the 8 rules of dividend investing is the hedge your bets rule. And then the quote here is from John Templeton, who says the only investors who shouldn't diversify are those who are right 100% of the time. If you believe that's you should certainly not be investing in individual stocks. No one's right 100% of the time. Common sense idea here is if you spread your bets over different businesses reasonably, this is the 20 to 30 stocks that we've discussed before, as time goes by, you'll accumulate a portfolio of high-quality businesses to hold for the long run. The quantitative rule here is to buy the highest ranked stock of which you own the least each month. And there's a bit more to it, and we go over that in our portfolio building guides and the newsletters, but that's the general idea behind it. And we do try to design that where it does limit from generating a giant portfolio over time. The empirical evidence for this is a study from Lawrence Fisher and James Lowry in 1970 found that 95% of the benefits of owning the entire New York Stock Exchange came from owning just 30 stocks. So instead of owning thousands of stocks, owning 30 gives you nearly all the benefits of diversification. And there's plenty other studies that will show similar results. A quick summary of the 8 rules of dividend investing. The first 5 rules are the buy rules, which are the quality rule, rank stocks by corporate history and dividend history, the bargain rule, rank stocks by dividend yield, the safety rule, rank stocks by share repurchase yield, the growth rule, rank stocks by the lower of, we're ranking stocks by growth rate, and the peace of mind rule, rank stocks by their long-term volatility. The 2 buy rules are the overpriced, the 2 sell rules are the overpriced rule, sell a stock when its adjusted price earnings ratio exceeds 40, and the survival of the fittest rule, sell stocks that reduce or eliminate their dividends. And finally, our portfolio rule is the hedge your bets rule, buy the highest ranked stock of which you own the least each month while you're building your portfolio, and be reasonably diversified. And with that said, seeing how it's almost Christmas time, I'm excited to announce an exclusive offer for webinar participants for our newsletters. When you think about our newsletters, what we've gone over in this presentation is the cost of investing in funds or with an investment advisor. The fees do add up. So an investment advisor that charges 1% a year, which is very common in the industry, if you have a $100,000 account, you're paying $1,000 a year. If you had $1 million account, you're paying $10,000 a year. Versus if you're using the Sure Dividend or Sure Retirement newsletter, we don't price them for the value that's in them. We really, at Sure Dividend, we want to reach as many people as possible about dividend growth investing and building an income portfolio. And so we price our newsletters at just $79 a year. And that is to get as many people as possible learning about dividend growth investing. And the difference between the 2 newsletters, the Sure Dividend newsletter focuses on dividend growth stocks. And so that's more what we've discussed in this presentation today. The average yield in the newsletter is around 3%. It's a bit higher right now, but generally it's around 3% for the recommendations with a range. Some are lower, some are higher. So these are long-term growth stocks that are also probably trading at a reasonable valuation. We won't invest in overvalued stocks as a rule. And then the Sure Retirement newsletter takes a slightly different approach. It still uses the 8 rules of dividend investing, but it invests exclusively in stocks with 4% plus yields. And it also invests in REITs and MLPs. So you'll get real estate investment trusts and oil and gas pipelines as well, which tend to have high yields. And the current highest ranked Sure Retirement newsletter stock or MLP has a yield well in excess of 10%. So the Sure Retirement newsletter is really has in mind investors who need current income today and have some income growth in the future. Of course, you have to give up something to get higher income today. So we expect the Sure Dividend newsletter stocks to be a bit safer and to possibly have greater long-term growth prospects. The Sure Retirement newsletter stocks are going to, and we don't exclude safety or growth in Sure Retirement by any means, but those stocks are going to have higher yields now with not as high of scores in other areas. And the bonus that we have today is we want to give you a $21 a year discount on either newsletter, and you can use the coming coupon code for either newsletter or both. We have a lot of people who read both newsletters, and that will reduce your price, which from the already very low price of $79 a year to $58 a year. And we're going to send an email with the discount link and the coupon code to use when the webinar finishes. And I just wanted to say to everyone, thank you for attending. I appreciate it. And I wanted to ask if anyone has any questions. And I'll be happy to take a few questions, answer them here. And Nick will also be in the comments as well. So if you have any questions, feel free to type them out now. And if there's not any questions, I will assume that I did a decent job on the presentation, and we'll leave it at that. I'll give it just a minute more though. Okay. What is the frequency of the newsletter? The frequency of the newsletter is it's published monthly, and we always publish on the first Sunday of the month. And I also want to add, we also have a 7-day free trial where you're not billed for 7 days. You can email me, cancel at any time in the 7 days. You won't even be charged. We want people to try it. All right. And that's it. I appreciate everyone's time again. Thanks for watching this webinar. And if you have any questions about dividend growth investing in the future, feel free to email ben@suredividend.com or nick@suredividend.com, and we're happy to help you out. As a caveat, we cannot take personal investment questions, but we can answer general questions. Okay, one more question. This is a very good question that I'm excited to answer. What's my take on whether or not we are going to experience a 2008-like crash? How do you invest when the market is going down? This is a great question. I mentioned the market's overvalued. It's significantly overvalued right now. This is a extremely unusual time in the market. High valuations. There are individual stocks that are undervalued, and that's what we look for, but they're few and far in between. The interest rates are extremely low, some of the lowest interest rates in history. So the whole, and then you look at the developed countries in the world, they have high debt to GDP ratios. And historically, when countries have a debt to GDP ratio above 100%, so they have more debt than their GDP, and the US is in this category, by the way, along with most European countries, and Japan actually has a 200% ratio, over 200. So it's even worse. And that's most of the developed nations in the world. They will exhibit very stagnant growth, tepid growth. And that's what we've seen in the US for a long time, and in other countries in Europe. So to answer the question, are we going to experience a 2008-like crash? I could see the markets cracking by 50% or 40 or 30%. I'm not here to make forecasts. Could that happen in 3 months? It could. Could it happen in 7 years? It could be 7 years from now. I don't know. And what I try to do is I try to focus on the things that I can control. I can control holding great businesses when there is a recession, so not selling if that happens, and collecting the dividend income, which if you invest in great dividend growth stocks, you're likely to generate rising dividend income. And if you look at just that dividend income during a recession, you're not going to see a hit to your lifestyle. The prices will go down, but it's your choice to sell. So don't sell when the prices decline. So you can control the psychological aspect, and on the same time, don't invest in overvalued stocks now. Most stocks are overvalued. In 2009, if you bought an index fund, you'd probably do really well. Most companies were undervalued then. At the bottom, in March 2009, it's a different story now, but there are still some undervalued stocks out there. And if you pick those, you're likely to do better, and you're not waiting to get into the market. That's a big mistake people make. I would have said what I said right now 4 years ago. I would have said the market's overvalued, there's tons of debt everywhere, interest rates are too low, we're due for a recession. And I would have missed 4 years of great returns. So you don't want to miss out on those great returns, but you do want to be able to control your reaction to a recession and to position yourself for that by investing in high quality companies likely to increase their dividends even through a recession. So that's my answer there. And one more question. I think I said that before. This is the final one. How many stock picks are in each newsletter? In each newsletter, we have 10 stock picks, the top 10 stocks ranked by the 8 Rules of Dividend Investing. They are different because the Sure Retirement newsletter only looks at 4% plus yielding stocks and MLPs and REITs, whereas Sure Dividend doesn't look at MLPs and REITs. And it looks at any yield amount. And there's very little overlap. Usually there'll be maybe 1 to 2 companies that are the same in each newsletter. But it is 10. We cover all 10 in detail. And we also have some opening and closing thoughts in the newsletter. Well, that concludes this webinar. I appreciate the questions. I appreciate everyone's time. Thank you and have a good night.